if you can run at a really accelerated pace, if you can convince people to give you their time to buy a product from you, or at least early on test that product alongside you and give meaningful feedback, and you can convince people who are exceptional to come and join you very early, you've probably got a lot of the attributes that are required to build and scale a technology company, because you can ship and you can sell.
Hi everyone, I'm your host Rohit Bhargava, and you are listening to episode 215 of the Startup Playbook podcast, a weekly series where I sit down with successful tech founders, investors and operators to unpack their journey, lessons and insights to help current and future entrepreneurs. My guest for this episode is Ben Dunphy, the co-founder and partner at January Capital. They're a VC fund that invests in early stage high growth technology startups across the Asia Pacific region. They also run an $85 million growth credit fund that offers scale stage companies access to non-dilutive capital. I first had Ben on the show in October 2016, and nearly a decade later, we revisit his journey and discuss what's changed and what hasn't in early stage investing, how January Capital is bridging the gap between equity and debt-based financing in an innovative model, the opportunities in Southeast Asia, and much more. Without further ado, here is my interview with Ben Dunphy. Hi Ben, welcome back to the Startup Playbook podcast, and thanks so much for making time for me on this trip.
Thanks for having me back.
Now, of course, we were just joking a little bit about the last time we did this was October 2016, so
I know.
Almost a decade ago. Back when the setup looked a little bit different as well. I think you still were part of that group that had the little tripod mic, and I would ask you to sit as close as possible to me without it being too uncomfortable. But Ben, obviously a lot has happened, and
Sure.
It's been a little while since we last caught up as well. But for those of our listeners that may not be as familiar with you and your story, do you want to share a little bit about your background and what got you here today?
Yeah, sure, absolutely. So I'm one of the founding partners of January Capital. So we're a technology investment firm. We're sitting here today in Singapore, which is our headquarters, but we invest pan-Asia Pacific. So most of our time's in Southeast Asia, but we also invest into India and Australia and New Zealand as well. So my background is an interesting one. I was born and raised in Australia, but really spent most of my career in broader Asia, and indeed spent time in the US as well. But I've been doing venture since 2015. We would have spoken when I was a year into that journey probably, so quite fresh to the investment world, but have been primarily deploying capital into software investments in this region for the last decade, and have had the privilege of being able to partner with really exceptional teams that have gone and demonstrated that, from this region, there is an opportunity to build global category leadership in different elements and categories of software. And I think that continues to be our North Star of what we're looking to do, is to partner with really fantastic teams at the earliest stage, really be there as their first institutional partner, but increasingly be able to support them through what we call their capital structure and their life cycle. So really be that long-term supportive partner that can help them through the journey of building something that's going to be enduring and ultimately long-term.
Yeah, amazing. Obviously, you mentioned, when we first did this, you were about a year into your journey at Blue Sky. And, I think one thing about venture investing, or just things in general, is I think you just learn so much more through that process. I guess from your own personal perspective, what are some of the things that have stayed the same and sort of stood the test of time over the last 9 years or so? And what are some things that have your perspective or your kind of approach has changed quite significantly from where it was in 2016?
Yeah, sure. So, when I jumped into venture in 2015, I don't think it was yet a proven fact that there was going to be this extraordinary level of value creation in software from founders that have a nexus or an initial story coming out of the Asia Pacific region. And I think what's really interesting today is, as we sit here on possibly another paradigm shift in technology driven by the potential of AI, that's a much more established fact. And that's awesome, because I think what we've seen play out over the last 10 to 15 years is a whole cohort of founders prove that there can be hundreds of billions of dollars of value created, and you don't have to necessarily start in a co-working space in San Francisco. And so that's a really consistent fact that I think we'll see more value created in the next decade in this region than in the prior decade. And so that certainly continues to be true. I think what you learn in venture is that it's a very long feedback loop, and that there is the potential for companies to grow and scale to be even larger than you could have possibly imagined when you wrote the investment memo 10 years ago or 9 years ago. And so I think for us, that's been, and for me personally, a learning. But I think what it really gives me a lot of comfort is the thesis that I sort of started with when I joined Venture as an associate 10 years ago, which is we're going to meet great people from this region and they've got the potential to do great things. That's absolutely still true. And that's the thing that we spend all of our time on today is looking for people that have that potential to take a global view and go build something special.
Yeah, it's interesting kind of mention about proving out a region. Like I remember back when we started the podcast, almost coming up to 9 years now, that was a lot of the conversation that we sort of had around then was, how do we prove out that Australia's got the opportunity to sort of build lasting, sizable returns for investors, and that was still to be sort of proven out. I guess how much of that experience in Australia has kind of shaped what you're doing in Asia now, or perspective, or is it completely different?
It's a good question. I think one of the things that I've learned, I guess, in the last decade is the potential of Asia and the potential of this region is immense. But if you bubble it down to what we do in the venture world, it's really about finding folks that have a particular view of the world and a force of nature that allows them to go and undeniably build something of permanence and endurance. And so what's interesting is I think there's a lot of narratives that will be in or out of favor every year or every decade. But what doesn't change is great entrepreneurial spirit, and that desire to go build ultimately is what we're seeking and looking for. And so the thing that we've, I think, become quite dogmatically focused on in the last 6 years of building January is that there are certain what we call areas of conviction or inquiry that we really deeply believe in, but they are narratives that we can move better depending on the entrepreneurs that we ultimately meet. Because I think for us, we want to be coming with a prepared mind, but ultimately it's about that individual, and that idea for that individual is something that they're going to undeniably go build behind. And so, I think there's been different views on the macroeconomic outlook of Southeast Asia, for example. And so last year, maybe Southeast Asia was less in favor than it was 4 years earlier. What we know, though, is that there's still going to be 10, 20, 30 fantastic teams that are going to start a company this year in this part of the world. And when we look back in 10 years from now, I think we will have been fortunate to have had the privilege to be here and have the potential to go back those teams and partner with them early on. And so for us, the learning's always been about coming back to the individual itself. The narratives will swirl around ultimately, but really at the simplest level for where we tend to play, which is very early stage, we're looking to partner with great individuals, and they'll ultimately figure it out regardless of what the macroeconomic narrative on a country or jurisdiction is going to be in a year or two's time.
We're going to take a very quick break from this podcast to talk about one of our partners, Vanta. So if you're building a SaaS business and want to quickly unlock growth and build customer trust, one way to do this is by achieving compliance with SOC 2, ISO 27001, CPS 234, Essential 8, or other in-demand compliance frameworks. However, this process is often time-intensive and very costly. Vanta automates up to 90% of compliance, making you audit-ready quickly and saving you up to 85% of associated costs. And not only that, Vanta scales with your business. With a market-leading trust management platform to help you continuously monitor compliance, unify risk management, and streamline security reviews. You can join over 8,000 global companies like Atlassian, Dovetail, and Indebted that use Vanta to build trust and prove security in real time. As a listener of the show, you can get up to $1,000 US off Vanta when you head over to vanta.com/demo. All right, let's get back to the episode. Speaking of that conviction, what did that look like for you in deciding to partner up to launch January Capital as well? We were just speaking about this off the record about there being great funds in Australia and just great funds sort of globally as well, and just kind of making sure that you have differentiated value add or something different to add to the market. What did that sort of look like in deciding and sort of refining what that was for January Capital?
Well, it's interesting. I think, our journey is, like many firms, a non-traditional one as to how you actually get started. We were nudged in the direction of launching the firm, but I think what we'd learned when we started January, and there was three of us, Jonathan Hodson, myself, and Jason Edwards, we had over time built conviction that there were certain things that we felt in what is still a relatively nascent private capital landscape for technology firms not yet fulfilled in terms of capital density. So we looked around us and saw many peers that had been in operation at that time in 2019 doing great things in certain areas. But we felt as though there were opportunities for us to continue to contribute to the ecosystem. And the beliefs of which I think we set up the firm continue to hold true today. So the first was that we felt as though we could, instead of sort of grow ever larger fund vintages in a particular asset class, we felt there was the opportunity to think about where there was the greatest need for capital and build bespoke teams and strategies that were going to help founders across their life cycle make sure that they had the right capital at the right time. So we started in the early stage on the venture capital side, and that's where we sort of built our muscle, made close to 60 investments. And then the belief we had at that time was we would start to see further opportunities that would ultimately allow us to expand our horizon if we met the right people that could be supportive of founders. So 2.5, nearly 3 years ago, what we had heard consistently from our portfolio was that they, as they reached the growth stage, wanted to think about a more diversified mix of capital, for example, in their way of financing their growth. And the consistent question we got from those later stage companies was, where can we go to source debt or credit? And the consistent sort of feedback that we'd come back with is, look, there's 1 or 2 firms that we know of and a lot of US-based firms, but they typically can't lend here from a mandate perspective. And that was the sort of aha moment, that there was probably a really catalytic capital need ultimately in this part of the world. So we established what we call a growth credit program, where we were able to go out and raise capital for us to be able to lend into companies in a less dilutive or non-dilutive fashion, to allow them to use that in a way that's going to allow them to fuel their growth by more than pure equity, which can be particularly expensive as a form of capital. And I think over time, we're seeing more opportunities across the life cycle. So all of that being said, I think we saw that there was a ton of fantastic work that had been done by a first generation of general partners in establishing and proving that the ecosystem in the broader Asia Pacific region had validity, but we could still see pockets of opportunity where we felt that if we played there, it was complementary and not competitive to the great work of the first generation of GPs that have been operating by 2019 for sometimes up to a decade.
Yeah. When do you think is the right time for startups to think about diversifying their mix of capital?
It's a good question. I think it's very dependent, as we've learned, on the business model. So if you're a fintech company that ultimately is going to require some form of debt capital early to on-lend as a way to generate a monetization method, that may be really early in their life cycle, which is not necessarily the product that we perhaps offer. I think when companies get to an early level of what we'd call growth in their life cycle, so in the delineation of different series, you're probably Series B plus. You've started to build out a proper finance function. You probably have a CFO in place. You've got someone who can spend the time thinking through what is the right way for us to finance the activities we have in terms of investment. That's commonly where we were finding our own portfolio when they were thinking about maybe a Series C financing. We're thinking, well, I know I've got interest for equity of X million, but I'd love Y million. And if I go and take up to Y, that's going to be more dilutive than we would like and existing shareholders would like. And so I think it is a relatively late stage that companies should think about it. The risk of taking on leverage too early is, one, you may not necessarily have a proven business model to a point where it is largely repeatable, and therefore your ability to service debt is less certain, and the risk there is that you get yourself into trouble. You ultimately fall short in terms of any covenants that might be in place, or you simply just don't have the sophistication in terms of finance capability to really understand that at some point that debt probably needs to be repaid. And that's where we've found companies have ultimately probably got ahead of themselves, and that's the risk, which is why we were quite specific that we felt really once you've got that dedicated finance function, you're on a clear pathway to profitability and your unit economics well, that's probably actually at a point where you're quite a low risk company in terms of being able to service debt. And if you've got sufficient equity coming in alongside you, that's when there can be quite a magical experience of being able to diversify your sources of capital, because then you can allocate those sources to the best use that ultimately allows you to service multiple forms of financing.
I'm just curious, does the fact that you sort of do both equity and credit change the way that you look at companies or assess it?
It's a great question.
So, whether you're looking at a deal that's just purely equity based, purely credit, I don't know if you do that, or a combination of the two, does the way that you sort of do DD or your own sort of investment thesis around that shift at all between the mix of investment that you make?
Yeah, it's a great question. It's something that we thought a lot about when we felt an increasing urgency to go and explore this second strategy in the firm. I think what we were able to be quite clear on is that the life cycle of company and the stage of the life cycle that we're ultimately investing into is very different. On our venture program, our ambition is really to partner with founders at that first stage. So that could be as early as pre-product, pre-revenue, and commonly is. So whereas our growth credit product really is companies that have reached a reasonable level of scale. So one, it's not intentional, and we're quite specific that we don't plan to co-invest often in companies where we'll have both credit and equity exposure. That clearly introduces the potential for conflict. There have been some instances already where it's made sense because it's an asset that we know and understand very deeply. We've been on the journey for many years. There's a high level of trust with the founder, and we can put together a package that is very complementary in nature. But for all intents and purposes, they're separate teams, separate investment decision-making structures. But the benefit is that you have a holistic knowledge base across the firm. And so one, there's usually relationships that have therefore been in existence for many years because we might have spoken to that company 4, 5, 6 years ago on the equity side, which means we should be able to, subject to the additional credit underwriting that might happen, make a really quick decision in terms of our ability to partner. So the belief we have is that, particularly for our credit team, if they have the benefit of all of the knowledge that we've accumulated and they themselves have, a very deep track record in this space, then we should be able to, within days or weeks, be able to say, yes, we're up for it. And that's something that we pride ourselves on at the firm. We believe in speed, and that doesn't just mean because we don't do an appropriate level of work. It's more so that we want to come to everything that we do with a prepared mind and a level of speciality and care, so that when a founder is interested in us leading a early stage round on the equity side, we've hopefully done that work, gotten to know them for an extended period, and we can make a decision very quickly. The same applies on credit because you have the benefit of the equity team having done a lot of that work maybe several years earlier.
Yeah. Structurally for you, does that mean that you have two separate teams or units to kind of look at either the equity or the credit side, or is it all lumped into?
Yeah, so for all intents and purposes, it is one cohesive investment team, but we have a dedicated speciality. So, within our investment team of 12, there are 3 full-time members that are dedicated to our credit offering, and the rest are dedicated to our equity program. So share ideas, speak all the time. They sit next to each other, but the idea ultimately is that those decisions are made by separate teams in essence. And that feels like the right way of being collegiate and collaborative, but still ultimately making sure that knowledge is only shared to the extent that each side's company's pipeline feel comfortable with that. So if, for example, we're speaking to a company on the equity side and they know that we have a loan out to a competitor, for example, then clearly we need to be careful around how we think about flow of information. So it's about making sure that we are respectful and operate independently where required, but still ultimately to the degree that we can share and collaborate so that we can make the best decisions on behalf of our limited partners and our investors.
Yeah. I feel like I'm still learning a lot about everything in general, but especially about this market in particular. And I think, from an outsider's perspective, it can be really easy to lump everything together as one homogenous being, which is not the case at all. And so, I guess from your perspective, for any investors that are looking into this particular part of the world, or even for startups that are thinking about, expanding into this area, what are some of the misconceptions or things that they should be aware of?
Look, I think the way that I look at Southeast Asia is it is in a region that is of immense opportunity, and we all can read and be aware of the sort of high level macro messaging around population size and potential growth. I think it's a really exciting region, but it's one where it's really requires a holistic approach, because you're going into what is ultimately 6 different major markets. The observation that we have is that therefore you've got to be very thoughtful around the business model that you employ. And that's one of the reasons we made when we started January, that when we invest into companies that we call building in Asia for Asia, they're primarily on the B2B side than the C side. I think what we've learned and observed over the last decade plus of operating in these markets, it's hard to take something that necessarily works in Indonesia and port that over to Vietnam with a high probability chance that it's going to be accepted by that. TikTok's probably the exception of it, and some of the e-commerce platforms, but I think that that's very few and far in between. And so when we started the firm, the decision that we made was, the digital infrastructure, as we call it, of the region looks and feels pretty similar. Supply chain problems are the same in Indonesia as they are in Thailand. Maybe not totally overlapping, but it's largely the same. Payments infrastructure, whilst disparate in nature, the same problem statements begin to appear. Things that businesses ultimately suffer from in terms of commercial issues are the same across markets as well. So I think our advice to founders is be really specific in, are you going to just be a single market business? Because there is the possibility, like in Australia, to build a reasonable business of scale in any one of the Southeast Asian jurisdictions. But I would say that if you're planning to be multi-market, that isn't a small undertaking. I think one of the things that we made the decision on, several years ago was it's as difficult to be multi-market in Southeast Asia as it is to be truly global from day one. And so one of the things that we've really, I think, aligned around as an investment team is probably starting to think more around global from day one opportunities as a greater percentage of what we invest into than necessarily looking for pan-regional as an idea. Because if it's going to end up being pan-regional, it either had the potential of being global, but that founding team's chosen not to do that for whatever reason. And so, I think that's one of the observations. And there's always examples that deviate from that rule. Shopback's a great example in our portfolio. When we had the privilege of investing into that business in 2017, I think it was non-obvious that they were going to have the success that they have had in being market leaders across so many different jurisdictions. But the learning you have is that the idea of saving money and getting the greatest value for a significant segment of consumers is something that has permanence across every market. And so there are certainly those opportunities, but we don't think that they necessarily turn up every day. Shopback is a special business in terms of right place, right time, an incredible founder perceptiveness and execution that has led them to fully capitalizing on that opportunity. And so I think for us, that's been it's a learning and how we've adjusted, how we've looked at the investment landscape.
Scendar is the OG startup accounting firm in Australia, catering to all stages of your business life. If you're busy running a business, you don't always have the time to do your own books and forecasts, and instead you can fully outsource your finance function so that you have the time and resources back to do what you do best, which is growing your business. They have a dedicated focus on founders, funds, and startups, and have an experienced team that can help you with everything from managing your tax to balancing your books to even helping with your exit strategy. I trust and use them with all of my businesses and can't recommend them highly enough. To find out more or to speak to Gareth and the team, head over to scendar.com. All right, let's get back to this episode. As you mentioned, you invest across the region and in Australia as well. So when you are assessing particular investment opportunities that are coming to you, do you look for different things based on where the founders are initially, setting up, or the early traction that they have? So does traction in Australia sort of translate in the same way that it would traction in Indonesia or traction in Singapore and vice versa?
It's a good question. So we've got a single investment committee on our venture program that, regardless of country of potential investee, are ultimately going to look at the same set of opportunities. So everything is measured to the same bar. One of the things that we're a really big believer in is the idea of contextualizing and understanding talent's background. So when we started the firm, what we thought really deeply about was we're a minnow in an ocean of very large established private equity and in some cases venture practices. How are we going to compete if we want to take a more regional approach? And so the decision we made, rather than maybe scaling our investment team into being multi-market in terms of physical coverage, was to invest into data science and engineering capability. The belief that we have and we continue to hold very dear to us is that there are certain attributes that can give you an idea of someone's propensity to be successful in entrepreneurial pursuits. To be clear, it's not that you can make a decision off of data, but it can give you a really good directional view of someone's background being a potential reason for them being exceptional in how they're going to perform if they started that entrepreneurial journey. So what we've built up over the last 6 years inside of January is what we think is the deepest database of human talent across Asia. And in fact, it's what I would call anyone that has a nexus to the Asia Pacific region. So really they can be based anywhere in any innovation center. And what we're looking at is we're creating composite scoring for those individuals. So what we've learned as we've gone and back tested and really done a lot of deep thinking on this topic over the last 6 years is there are certain attributes that are going to give you a good indication of someone's propensity to be successful. So teams that you've worked in within certain technology companies, years that you might have matriculated at certain academic institutions, professors that you worked under in writing your PhD, academic articles that you've published as part of a consortium of different associate professors. All of those things start to give you an indication that someone has a level of exceptionalism that may make them great as they start to think about building something. And then the way that we sift through that is by taking a very automated approach to benchmarking and scoring. And that gives us a really magic, pipe of understanding who we think may be starting something and, having an early level of engagement with a broad cross-section. We constrain that to ultimately 4 themes that we look at. We call the future of commerce, the digitization of financial services, digitization of essentials, and software that's built with an Asia-Pacific nexus, but ultimately have global application. And that's all we spend our time on. So for us, we think of talent as the core basis of our investment decisions. And then by being, quite thematically focused, we're able to hopefully come with a prepared mind to make decisions quickly when we meet special individuals that allow us to join their journey in building something.
Yeah, I don't know if I've mentioned this to you before, but so we've got an investment syndicate as well that came off the back of the podcast.
Yep.
And we specialize in pre-seed and seed stage investments as well.
Yeah.
Very similar to you. A lot of the time we invest pre-product, pre-revenue, and by nature, you don't have a ton of data to go off. And, the large emphasis sort of goes on to the founding team and your sort of belief in them and their capabilities to execute, and whether, if they execute, whether there's a big enough market opportunity off the back of it to be worth going after. But again, that, I feel like our process kind of developed to a point where we would get a pretty good sense or a feeling of what that, as you mentioned, the bar is. But it can be hard to sort of translate that from a founder perspective in knowing what does that look like, because they don't get the benefit of seeing hundreds of different companies a year. Do you want to maybe share what that part of that process looks like? Or you mentioned particular attributes on things, like what are specific things that sort of stand out to you that stand out for you from a DD perspective?
Look, I think one of the things we've learned is, like any firm, there is a lot of imperfection in trying to assess a founder in a very short period of time when they've made the decision to raise capital. So they're going out to the market. I think lots of firms take different approaches to try and mitigate against that risk. Either it comes from a network that they've known for many years. They've been inside of a FANG company for 15 years, and therefore I'm only going to invest into people I've known and worked with. There's a whole bunch of approaches. What we've learned is that if we can, our core attribute in decision making around our pipe is our speed to founder. So, how early can we reach people in their ideation process and hopefully be on that journey alongside them for a minimum of 1 to 2 months, hopefully longer, 6 to 12 months, where we can spend time being helpful and just being a thought partner. But ultimately what we've learned is that we see their ability to execute. And the things that I personally look for is the agility in early product execution and the ability to ship features that ultimately translates into early design partners, and the ability for founders to be able to attract talent that I personally don't think that I would ever be able to convince to join me at that stage in the journey. And that all sounds really straightforward and simple, but the things that we've learned is if you can run at a really accelerated pace, if you can convince people to give you their time to buy a product from you, or at least early on test that product alongside you and give meaningful feedback, and you can convince people who are exceptional to come and join you very early, you've probably got a lot of the attributes that are required to build and scale a technology company, because you can ship and you can sell. And that is really something that when you meet the right individual, you see that and you understand it really quickly. That's the magic. And I think that only comes from being able to see people execute for a reasonable period of time.
As you mentioned, one of the challenges of, especially if you want to make your investment decisions really quickly, is if your first touch point with the founder is when they're fundraising, they say we've got 2 weeks for you to make a decision on things. Again, it can be sort of counterintuitive for, I guess from a founder lens, it's tough to know when's the right time to reach out to investors. What should that look like? What should, I don't want to bug them. I don't want to sort of reach out to them when it's too early and their feedback to me is like it's not the right thing, versus if we'd made a little bit more progress, that might be a little bit further along. Do you want to share from your perspective when the right time is for founders to reach out and start having those conversations, and what does the ideal look like for you when you talk about building those relationships early so you can get to those decisions a lot quicker? What does that ideally look like from your perspective?
It's a good question. One of the things about us is about 95% of our deal flow starts from us reaching out. So one of the things we've learned is founders by nature are so busy and they're so focused on finding product market fit. And I think observation that we will never beat out of founders is only go to investors when you're ready to fundraise. And there's a lot of validity in that. You've done the thinking around the narrative, but we really like to dive in and understand a thought process and also understand how we can be helpful early on. And so the advice that we continue to give to founders is there's probably not a lot of validity in going out and speaking to 25 investors before you're ready, but where there is investors proactively reaching out and interested to learn, and they have a track record of investing in companies that would be adjacent to or within your sphere of what you're looking to build, many of those investors are really interested in being supportive and participating early in a company's ideation phase, because it allows them to build conviction and surface that to a broader investment committee, partnership, whatever it might be, so that you're very much on their radar. I think there's no perfect answer to it, but for us, we have a really strongly held belief that if someone comes to us ready to raise capital and is looking for us to make a decision within a week or two of meeting them, we've done it. But I think our learning over the course of us building the firm is that we have a much stronger preference to have spent the time whiteboarding, to have spent the time understanding the depths of a founder's background and why this is their life's work and why this is going to be something they want to spend the next decade working on. And I think that's a really difficult thing to translate in a deck and in a few hours talking to someone. So if you're looking for an investor that's going to lead a financing round and be a great partner, reaching out early allows you to take your own mutual due diligence. Because if you ask us for assistance and we ghost you, or we are non-responsive, or just can't offer up the value we say we can, then you learn a lot that may not be the investor for you. And so the beauty of us having more time to get to know each other is what we call, it's a diligent approach for us, but it's also about us generating rapport. Like, we have to earn the right, therefore, to show that we can be someone that can be truly helpful for that stage of a company's life cycle. So I always encourage people that you don't need to go and speak to 20 investors, but if people are actively reaching out, there's no harm in inviting them to start to build a relationship. And founders will know within the first meeting with an investor, is this someone that I could work with for the next 10 years, or is this just not a relationship that I could maintain for a decade-long arc. So that's how I think about it.
We're going to take a very quick break from this podcast to talk about something really important and meaningful, and probably something that a lot of you listening can relate to. For the last few years, I've had a front row seat into how challenging and difficult it can be to build something meaningful. The late nights, the constant pressure, the feeling that no matter how well you're doing, there's always more to do, and that whatever you're doing is never enough. For a long time, I thought that was just a trade-off. To be successful in business, everything else, your health, your fitness, your relationships, had to take a back seat. But what if that wasn't true? As an investor, I know that the most successful and impactful businesses are built over decades, not over months. But so often we approach life at our businesses as if we're running a 100-meter sprint rather than the marathon that we're truly running. These are the questions and insights that led me to launching the Como Club, the world's first human accelerator. Early this year, we brought together 26 incredible people, from founders, investors, professional athletes, to senior executives at some of the largest companies. It's an 8-week program designed for high performers to implement systems for long-term success in their business and all areas of their life, from fitness to mental health, relationships, and leadership, all within a trusted and high-caliber community that just gets it. So if you've been doing well but know there's another level, or if you've been running hard and want to recalibrate, I'd love for you to check it out. Cohort 2 kicks off in August and applications are now open. You can find out more details or apply at the Como Club, that's TheKomoclub.com. All right, let's get back to this episode. Part of, I guess, getting founders early is, really interesting to learn that sort of 95% of your conversations happen from you doing sort of more outbound activity. Do you spend any time at all sort of thinking about like scaling that? Because it gets, from an investing perspective, an investment fund perspective, it can get really difficult as well. It's not like you've got a team of 100 people or so that are going out and having all these conversations. And so just being mindful of your time, how much does content, or you kind of mentioned sort of your data and engineering team, like how did that help support your kind of overall approach?
It's a great question. I think the most challenging part is that in early stage investing, there is almost an unlimited amount of people thinking about building something at any one point in time. That's what makes it great, but that's what makes it, as we call it, almost an unmappable universe. And that's where the power of data can apply in terms of being able to understand the parameters of a community of people building at any point in time, and allowing us to understand the people that we would be most excited by based on our beliefs of the world, so that we can make sure that we spend our time reaching out to those that we feel like we're going to have the greatest affinity with and the greatest level of conviction. Because there's two things that we believe deeply. One is we don't want to waste founders' times. Founders' time is the most valuable thing that they have, way more than any capital that they ultimately raise. And so when we make outreach, it should only be to people that we've gone and done the thinking and work to say, is this someone that we would really deeply take a look at, because we want to make sure that we're respectful of their time. The second is, I think as you do more and more investments as an investor, and you spend years to a decade inside of a firm or inside of the space of a particular category of venture, you start to build pretty good memory around these are the people that you're going to get most excited by. And so being able to know what you're looking for allows us to therefore focus our time. So it sounds like we're reaching out to hundreds or thousands of people. No, the reality is that any one of our investment team members is probably reaching out to, a handful of people a week. But we've started with a very large universe that is largely automated in approach. And then we're whittling our way down to people that we really think we would want to partner with. So when we reach out for the first time, the intention is that we have a decent degree of confidence that if things were to be validated and they were to move at the pace we would hope and prove out to be a capable recruiter of talent, we would have the opportunity to offer them a partnership in the form of us, leading a pre-seed or a seed financing round. So that's been our framework and approach.
I love that approach. What is it that you're specifically looking for in that initial meeting? Like what are, I guess you're kind of coming at it with the intention of, you've got a little bit of data on that individual and they have the markers of something that could be interesting. What are the things that kind of help tip that and move that further forward or put pause?
The greatest, call it pitch meetings that I've ever been a part of, and the founders that we've made the decision in a really accelerated fashion to say this is someone subject to, an appropriate level of diligence we'd love to partner with, is two founders. One is a CEO called William Lee, who runs a business called Akalaku, which is one of the largest diversified digital financial services firms in Asia. Has gone on to build a business that was much larger than we ever thought was possible when we wrote the investment memo. In that first session, which we were scheduled to do in Jakarta for an hour, which ran to 2, we never had a deck. There was no deck. And there was a whiteboard like the one that's behind us. And he spent 2 hours just completely unpacking, 1, the thesis and the vision that he had for this, and 2, the way that they had gone about building the business up until that point, and why that was going to be an exceptional platform to scale from. And that was a business that was post-revenue generating, so there were metrics that were really impressive and exciting. But what I just got so enthused by is like, this is someone without any slides or props can just completely unpack their mission, and they're so deeply embedded in what they want to go and achieve. And that is something that we really love, because that speaks to someone's life's work, and it speaks to the obsessiveness of that problem statement. And so, those are examples where when you sit there, you get the warm and fuzzies, because you're like, this is someone who's in the peak of their career that just is so locked in and so excited about what the potential is to build. And that feels like an undeniable feeling at that time that this is someone that I'm going to learn from. I'd love to partner with, because they're clearly, in their craft and their practice, such a specialist.
Yeah.
Yeah.
You touched on sort of obsessiveness and someone doing their life's work. Are there any other particular attributes that you look for that give you the warm and fuzzies? As you put it on those sort of early stage founders.
I think for us, that ability to articulate someone's thinking sounds so just pedestrian, and that should be obvious, right? But I think often when you ask a sort of an increasing level of questions around certain depths of how someone's thinking about something, you do see people tend to tap out in terms of a level of conviction and a deeply held belief. And the meetings that I always love is that people are dogmatic in their view, and they will preface that we don't have the data yet, or this is not yet fully proven out, but they've got a really strong worldview, and there is a clear narrative and thesis as to why they hold that. I think that's something that always is really encouraging, because it can be, call it, it's an overused word, but it could be contrarian in nature. But more than anything, it's just really well thought through, and that speaks to the time that they've spent sort of refining their view of the world. I think the second piece is, what gets us really excited is that when you spend time with a founder, which is, usually a 1-to-1 or 1-to-2 type conversation, and they're like, hey, these are 2 other folks we've brought on already early in the journey, you should go spend time with them. They're not in the room. You hear the exact same thing, the exact same vision and mission statement through the course of an hour with those individuals, and they're just as exceptional as the founder. You're like, wow, this is a pretty special team that appears to all be fully cohesive and aligned. Either they're really good at preparing for this and that looks very natural, but commonly that's what gets us really excited, because you can't do it alone. And clearly in a relatively short period of time, they may have only been working on this idea together for weeks or months. They've all bought into this idea and view of the world, which means that you can now go and distribute that team out to different gnarly problems that you're ultimately going to have to go individually solve. But hopefully you're going to end up working in a very cohesive manner. And again, all this stuff sounds pretty motherhood and pretty simple in nature, but to actually do that, I think early on in the sort of chaos of building a business, that's really hard to do. And it's very rare to have multiple people very early in a company's journey aligned on the view of the world, which, as we've learned, may be totally wrong and may pivot multiple times. But if they do that in an aligned way, then they will eventually find something that fits more commonly than not. But all of the other issues often emerge that restrict their ability to go do that.
Yeah, amazing. Ben, absolute pleasure having you back on the show after all this time. For anyone that's listening that wants to find out more, say hello, get in touch, what's the best way for them to do that?
LinkedIn. It's where we spend a lot of our time. So yeah, if anyone is building in the categories that we spend our time in, and as we like to say, there's never too early to come and speak to us. Love to continue the conversation with folks building in categories that we deeply believe in.
Amazing, love it. I will make sure I add those links in the show notes. Ben, once again, thanks so much for making time, and great to catch up again.
Thanks, Rob.
Thanks for listening to episode 215 of the Startup Playbook podcast. As always, full show notes from this episode will be available at startupplaybook.co. I'll be back next week with another episode, but in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.